Okay, let's go ahead and talk about partnership income distribution. Now, basically what this is going to boil down to is simply a matter of following a recipe, a simple mechanical process, allocating income based upon predetermined rules. Now, in the absence of a written agreement to the contrary, partnership income will simply be divided equally among the partners. So if you have two partners, it will be split 50-50. If you have three partners, they'll each get a third, and so on. Now, generally, since income distribution is going to be one of the most potentially contentious issues in a partnership, it would be almost inconceivable that a partnership would be formed without a prior agreement to how earnings will be distributed. Now, in a sole proprietorship, the income summary account is closed to the owner's capital account. In a corporation, the income summary account is closed to retained earnings. In this case, in the case of a partnership, the income summary account will be closed to the various partners' individual capital accounts. So, if the ABC partnership had no agreement to the contrary and had three partners, and they had agreement of income of $150,000, the closing entry at the end of the period would simply be to debit income summary and allocate $50,000 of capital to each of the three partners. Now, rather than simply following an equal distribution of income, most partnership agreements will allocate the income based on any of a number of factors. First, some partners might devote more time to the business than others. It therefore might be reasonable to allocate a larger portion of the income to them. So for that reason, we might indicate a given salary to each partner. Similarly, some partners might have more of their wealth tied up in the partnership than others, as evidenced by their capital balances. They might therefore be entitled to more of the partnership income. Some partners might have better skills than others or be more adept at bringing in clients. Again, for that reason, a non-equal division of income might be appropriate. Basically, we're going to have a recipe or an algorithm which we're going to mechanically follow in allocating the earnings. Let's go ahead and run through an example. Let's assume the ABC partnership had income of $200,000 in the current period, and they've agreed that income will be allocated in the following manner. First, A will receive a salary of $80,000 per year, while C will receive a salary of $100,000 per year. Next, each partner will receive a 10% return on their capital balance. Again, this is meant to compensate them for having their wealth tied up in the partnership. And finally, any remaining income or deficit will be allocated on a 10% to 40% to 50% basis, or a 1 to 4 to 5 ratio. And let's assume the partners' capital balances are A, 500,000, B, 200,000, and C, 300,000. So basically we're going to go ahead and set up a little allocation table. And first, a salary of $80,000 to partner A and $100,000 to partner C for a total of $180,000. Now it's important to note that this salary is not an expense. It's not a salary in the usual sense of a term where you debit salary expense and credit cash or accounts or wages payable. This is simply part of the allocation process. Again, it's not an expense. We're taking the net income after deducting all the expenses and allocating it based on this algorithm. We simply refer to this as a salary because it's often thought of as being compensation for the effort the person puts in to working for the partnership. Next, we have our return on capital. Again, they're all going to get 10% of their capital balance. So A will get $50,000, B will get $20,000, and C will get $30,000 for a total of $100,000. Now at this point, we've allocated $180,000 in salary and $100,000 as a return on capital, so we've allocated $280,000. We've only got $200,000 of income, so the remainder in this case is negative. And again, the recipe says any remainder at the end is going to be allocated on a 1 to 4 to 5 ratio. So of that $80,000 negative remainder, A will be allocated 10% or $8,000, B will be allocated 40% or $32,000, C will be allocated 50% or $40,000 for a total of $80,000. As a result of this, the total allocation to A will be 122,000. B is going to have a negative allocation of 12,000, and C will have an allocation of 90,000. And again, there's a check figure built in here. The total allocated has to be $200,000. That's the income that we had available to distribute. So based on this recipe, based on this cookbook, we're going to go ahead and close our income summary account. We're going to go ahead and allocate $122,000 to partner A's capital account. We're going to take away $12,000 from partner B's capital account, and we're going to allocate $90,000 to partner C. Now obviously partner B is not going to be happy about the results this year, but again, this is, it's assumed that A, B, and C are all legally competent adults who can enter into contracts, and if they agree that this is the algorithm they're going to follow, then this is the algorithm they follow. They can agree on any income distribution plan that they want to. And it could be that if there's a positive remainder, it's split one way. If it's a negative remainder, it's split another way. They could have a rule saying that it's not allowable that one partner has a negative allocation while the others have positive allocations. Again, whatever they can agree to would be allowable. Again, the partners can agree on any recipe that they wish. Now, let's go ahead and talk about this return on capital idea a little bit more. If the partnership agreement provides for a return on capital, then a partner might try to game the system by making a large contribution just before year end. Again, if you're going to get a 10% return on your capital that's invested, what you would do if you were sort of cynical, you'd say, okay, I'm going to go to the bank, take out an overnight loan for $1 million, invest it in the partnership on December 31st, get my 10% return on that $1 million or $100,000, and then pay off the loan the next day. So obviously that wouldn't be in the spirit of the affair. So instead of allocating a return on end-of-year capital, the return on capital is going to be based on an average capital balance during the year. And this would be an average which takes into account how long the capital was invested during the year. The computational principle here is identical to that used when you computed weighted average shares outstanding for computing earnings per share in your financial accounting class, in your intermediate 2 class, or wherever you happen to see that topic. Okay, so let's go ahead and do an example. Let's assume that a partner has the following information regarding their capital balance. At the beginning of the year, the partner has a capital balance of $500,000. On March 1st, the partner makes a contribution of $30,000. On August 1st, the partner withdraws $300,000. And then on December 1st, the partner makes a contribution of $600,000 for an end-of-year capital balance of $830,000. And again, what we want to do is find the weighted average capital balance, which takes into account how long these various amounts were invested in the partnership. How long during the year were these amounts available for the partnership to invest? The computation of the weighted average capital balance is going to be very similar to the calculation of the weighted average shares outstanding. And as was the case there are a number of algebraically equivalent ways to do this computation. My personal preference is to do it on a transaction by transaction basis. So our beginning balance of $500,000, that was invested for the entire year from January through December. So $500,000 invested for 12/12ths of a year is 500,000 weighted dollars. Next, on March 1st, the partner contributed $30,000. That $30,000 was invested for March through December, or 10/12ths of a year. So $30,000 invested for 10/12ths of a year is equivalent to 25,000 weighted dollars. On August 1st, the partner took out $300,000. So that money was taken away from the partnership for August through December, or 5/12ths of a year. So $300,000 being taken away for 5/12ths of a year is the same as 125,000 weighted dollars being taken away. And again, please note the subtraction here. We're taking money away out of the partner's capital balance. And then finally, the partner made that $600,000 contribution on December 1st. That money was only invested for 1/12 of a year. So $600,000 invested for 1/12 of a year is 50,000 weighted dollars. So the total weighted average capital balance is $450,000. And again, that's substantially less than the partner's end-of-year capital balance. In fact, it's less than his balance in January, less than his balance all the way through the end of July. The issue, of course, is that, again, that final large investment of $600,000 wasn't made until December 1st. That money wasn't available for the partnership's use except for 1/12 of the year. So if the partner is going to receive a 10% return on weighted average capital, the partner would get 10% of $450,000 or $45,000.